So first of all, the global trade war was already prior to April seen as the biggest risk by many family offices. In fact, actually 70% of family offices that we surveyed thought this was the primary risk for 2025. Now, what we're looking for, on the one hand, the global economy, principally driven by the US economy, to slow down in the very near term. This is in large part due to the uncertainty created by this constant threat retreat on tariffs and other issues, leading to entrepreneurs holding back on investments. And second, ultimately, when we're looking at the effective tariff rates right now, roughly 15%, largest consumer tax increases in the United States we've seen in recent peacetime. The impact is going to be somewhat lessened because of these and Europe. Inflation, likely going to see a pickup in the United States. Elsewhere, we're seeing continued disinflation. However, we do think that also the Federal Reserve will start to cut interest rates later this year as a result of a cooling labor market that will look to prioritize over inflation. And lastly, I think with regards to positioning, this is very much something where you want to think about excess dollar positions, as well as also too long duration fixed income instruments, because these will most likely be impacted the hardest. And we're already starting to see this. I mean, just to give you an example, US family offices, for example, principally focus on short to medium duration fixed income rather than long duration to diversify their portfolios. With regards to trade taxes, means that many entrepreneurs are holding back on investments. And second, look, even at the current level, the effective tariff rate in the United States is around 6 times higher than where it stood at the beginning of the year. So this is still one of the biggest consumer tax increases we've seen in recent peacetime history. Now, with regards to the global economy, I think what's important to remember is this is not the 1930s. So this is not everybody putting tariffs on one another. This is the United States versus the rest of the world. The other regions are happily trading with each other. So there, what you are likely going to see is that the slowdown is maybe not as harsh as one might otherwise expect. And it is also still, supported by both fiscal as well as monetary policy support that is coming through both in Europe, but also in China. Now, with regards to inflation, our view is that in the United States, we will be seeing a pickup in inflation, largely due to these trade taxes coming through. What will be important to see is whether or not this is a more lasting increase in inflation, also based on increase on profit margins from companies that use the tariffs as a story that they can create in order to lift prices. But I think one shouldn't get too worried about some hyperinflationary scenarios, for example, quite simply because given a cooling in the labor market, it does not seem too likely that there will be a chance for employees in a broad range of industries to increase nominal wages. I think it's really two things the first that you have to look at. The first one is you want to be looking at where do you have the structural growth themes that can endure even despite all of this uncertainty. And that is in large part related to AI. It is related to electrification. We call it power and resources. It is related to healthcare themes such as longevity. And you can play these through both public and private markets. And this is also something that many family offices are picking up. And the second one is really you want to look towards which asset classes can help you enhance yield and at the same time also diversify. And here we do find value in, for example, areas such as short to medium duration, high quality fixed income. But when you're thinking about diversification, also areas such as hedge funds and precious metals, gold in particular, are likely going to support that. So our view is effectively that it is in large part the structural growth themes around AI, power and resources, and longevity, so linked to healthcare, that are going to endure here. And you can, as I mentioned, you can play this through both public as well as private markets, and you can also play this across a range of different sectors. So with regards to AI, for example, it's not only about the companies that are producing technology, but increasingly also about the companies that are using the technology. Think financial services or the healthcare sector, for example, where either because of cost-cutting initiatives that you can put through with the use of AI, or faster drug developments we can use in healthcare, you can benefit. Power and resources, very broad. It starts from companies in the commodity space that help actually, provide electricity, towards companies that can store, distribute those, but also data centers. And financial services, catering towards people that live for longer, but also a healthy life for longer. What's critical is that you continue to have a focus on some of the key advantages that family offices have. And that is namely, you have access to patient capital. You don't have any restrictions, at least unless they're self-imposed, no restrictions as to where one needs to invest. And as a result, one can have a long-term view and diversify globally and broadly also to ultimately capture structural growth, enhance yield, and diversify. And we are seeing that many family offices are doing just that.